Greetings to our followers. This is Fidel Bisford. Today we shall kick off with REB Entrepreneurship Senior 6 and Unit 1 Ledgers and Trial Balance. We shall kick off with Lesson 1, the meaning and types of ledgers, and our intended objectives. By the end of this lesson, we need all our followers, learners, and educators to be able to define a ledger, differentiate a ledger from a journal, identify types of ledgers, summarize how and what to post from the prime books of original entries to the ledgers. Then we have definition of key concepts. A ledger is defined as a collection or a set of accounts of a business, and it is also defined as a principal book of account that summarizes and organizes transactions by account. For instance, all transactions relating to cash movement will be recorded in cash account. The ledger meaning in simplest explanations without caring much to the sophisticated financial terms. A ledger is like a notebook where all businesses' financial transactions are organized and recorded in two specific categories. It can be just in an accounting software during this time of digitized accounting and ways of recording financial information. So each category represents a different type of account. Such as cash, sales, rent expenses, capital, and many other depending on nature of transactions. I want us that while preparing a ledger, to think of this way. Imagine you're keeping track of your money. You might have a page for the money you earn, a page for the money you spend, a page for the money people owe you, and a page for money you owe to others. Posting is the process of transferring information from the book of original entries to the ledger accounts, whereas generalizing is the process of recording transactions in journals. So generalizing comes first because posting is taking information from the journals to the ledgers. So posting comes after generalizing. There is a difference between journal and ledger. So there's a number of differences. A journal is the book of original entry, whereas a ledger is the book of second entry. You need a journal for you to prepare a ledger. Entries from the journal end up in the ledger, but ledger entries do not go back to the journal. They go to the trial balance. Journal records transactions in a chronological order, while ledger records transactions in analytical order. The unit of classification of data within the journal is the transaction, while the unit of classification in the ledger is account. The process of recording information in the journal is called generalizing, while recording information in the ledger, transferring information in the ledger, is called posting. The examples of journals include sales journals or sales daybook, purchases daybook, sales return daybook, purchases returned daybook or purchases returned journal, cash book journal, petty cash book, and general journal. While examples on the ledgers include sales ledger, purchase ledger, and general ledger. So the primary purpose of a ledger is simply to summarize and organize transactions by account. The first step in accounting in summarized accounting process is recording the journal. Posting to the ledger is the second step in an accounting cycle. Then third, balancing of the accounts, preparing the trial balance, and finally, preparing financial statements, including balance sheet, income statement, statement of changes in equities, the statement of comprehensive income, the cash flow statements, and many other statements depending on the type of transactions. We have three types of ledgers: the general ledgers, also termed as normal ledgers. We have the sales ledgers and purchases ledgers. The general ledgers or normal ledgers, this is a ledger that contains all accounts of the business except credit sales, and purchases. Example: assets, liabilities, incomes, expenses, and capital. Notably, personal accounts of debtors and creditors who do not arise out of the sale or purchase of goods on credit are kept in the general ledger. Example: debtors as a result of the sale of fixed asset on credit and expense creditors. We have the second type, sales ledger, also termed as debtors ledger. This is a collection of all accounts of people or businesses to whom the business has sold goods on credit. These are the debtors, the customers of the businesses who took goods. They are billed or just are given services. They are billed, but no cash is paid yet. So the books that will help us record this information is called a debtor ledger. So the number last, purchases ledger, or also termed as creditors ledger. This is a collection of accounts of people or businesses from whom the business has bought goods on credit. These are creditors. So the books where we record information pertaining to the suppliers to whom the business owes money, the suppliers to whom the business owes money. The business bought goods from the suppliers, but the goods were billed, but still not paid for. So the book which will help us recognize this is a creditor ledger. We have a summary here of posting from prime books to ledgers. The information in the general journal will have to be posted to the general ledger. Information pertaining to purchases journal. Each credit purchase from the creditor, it has to be posted to the creditor's ledger. The total purchases on credit will have to be transferred to the general ledger. Under an account called purchases account under general ledger. For the purchases returns journal, also termed as returns outward journal, because you're returning goods to the suppliers. Each return to a creditor will be posted to the creditor's ledger, and the total purchases returns will be taken to the general ledger and an account called returns outward account or the purchases returns account. Going to the sales journal, each credit sale to a debtor will have to be posted to the sales ledger or debtor's ledger. Then the total sales on credit for sales journal is transferred to the general ledger and an account called sales account. The sales return journal or returns inward journal, each return from a debtor will have to be posted to the debtor's ledger. And the total sales returns will be transferred to the general ledger and an account called sales returns account or the returns inward and account. Notably, cash book or all forms of the cash book of all forms, be it the single, the double, the triple, the petty cash, all forms of the cash book will have to be reflected in general ledger, sales ledgers, purchase ledgers, depending on types of transaction, be it the cash receipts or the cash payment. We have here an information to remember. Record the rules of double entry. For every transaction, it has to be reflected in two accounts. For every transaction affects at least two accounts. If a transaction happens, it has to be reflected at least in two accounts, but even three accounts are possible, like in the case of starting a business with both cash at hand and cash at bank. You will have the triple effect. There must be one debit entry and one credit entry at least, because even the triple entries exist. But for the double entry, as the term double is, there must be debit entry. For every debit entry, there should be a corresponding credit entry. The total credit must be equal to the total debit. Particulars or details in the account will become names of the other accounts where double entry is recorded. The particulars, the details in the account will become names of other accounts where double entry is recorded. I hope that you remember this when reflecting the double entry. We have here a summary of the rules by the types of account, the increase, decrease, and we have here the normal balance. For the asset accounts, like a machine, when increasing an asset account, you have to debit. While decreasing it, you have to credit, and the balance comes on the debit side, which means that it has a debit balance, meaning that the debit side is always greater than the credit side. For the liabilities account, like the creditors or the account payables, increasing a liability account, you have to credit. Decreasing a liability account, you have to debit the account. Then a balance will be credit balance, which means that the credit side will be greater than the debit side on the liability accounts. For the capital accounts, when increasing capital, you have to credit. Decreasing capital, you have to debit the capital account. Then the balance will come to the credit side, which means that the capital accounts will have the credit balance. The credit side will always exceed the debit side of this type of account. Revenue or income account, interest received, commission received, any type of income or revenue, you have to credit. A revenue like sales, the sales account, sales made through trading activities, sales, you have to credit. Then reducing sales, you have to debit. Then the balance will be credit, which means that revenue and income accounts will always have the credit side, which greater than debit side. For the expenses, for the expense accounts like water bills, the depreciation, the loss accounts, electricity bills, rates, and many others, you have to do what? You have to debit those accounts when you are increasing them. Decreasing them, you have to credit them. Then the normal balance is debit. After passing the double entries, you have to balance of each account. Here are the steps. Step number one, you will have to sum up two sides separately to find out the total of each. Step number two, you subtract the smaller side total from the bigger side to just obtain, to arrive at a balancing figure. Then you record the differences on the smaller side. The other balancing figure has to be put on the smaller side, and you call it the balance carried down or the balance carried forward using the last date of the month. Step number four, now both sides are equal. Here you compute the totals. Then you draw two lines on the totals. Step number five, put the balance carried down's amount on the opposite, on the bigger side of the account, and call it the balance brought down or the balance brought forward using the first date of the next month or the next period. Without a delay, we have an introductory activity here. On 1st June 2021, John started a business with 200,000, of which 100,000 was at the bank account. 2nd June 2021, he purchased a machine for his business and paid 80,000 francs. Then we are required to prepare John's general journal and make necessary postings to the ledgers. Remember, the general ledger is a list of all businesses transactions organized by account. Here is the correction of our introductory activity. Correction of the question. The question states, the question hereby states, on 1st June 2021, John started a business. When we are starting a business, remember any asset that you use to start a business forms a part of the capital. So here by seeing started a business or commenced a business, automatically we have an account called capital. Now, started with 200,000 francs, of which 100,000 francs was at the bank account. This means that the remaining 100,000 francs was in the business cash drawers, which means that we have cash and bank account. Here, on this transaction that happened on 1st June, we have triple effects. Capital, the effect on capital, we are increasing capital, at the same time increasing the asset cash and asset bank. So we shall have to debit cash with 100,000, debit bank, and the total is credited as capital. Then remember the narration being the capital introduced in the business. The second transaction states, 2nd June 2021, he purchased a machine for his business and paid cash. We have two assets here. We have a machine. This is an asset account, and we have cash asset account. Which one is increasing? Which one is decreasing? We are increasing a machine. That's an asset account. It has to be debited because remember a rule, when we are increasing an asset, we have to debit. Then here we are decreasing an asset cash, and when we are decreasing an asset, we have to credit. So we shall debit machine and credit cash. And our narration will be being the purchase of a machine on cash. Then at the end, we have to compute the total at the last date of the month. On 30th of June 2021, we shall have a total on the debit side, which is 280 francs, and a total on the credit side, that is 280 francs. Automatically, we have to do the postings. Remember the meaning of posting. It's transferring information from the journal to the general to the ledgers, from the journal to the ledgers. We shall take all these information the way they are. The cash, we shall debit cash. We shall take this on the debit side, capital this on credit side. Then we take the machine like this. Here we go. For the general ledger, we have here the capital account. We organize our books in form of accounts in a T form. As you can see, this side, the left side is for debit and the right side is for the credit here. Then each side has date details for you and amount. Date details for the amount. Here we shall credit capital, and remember in details we shall write there cash, because the corresponding account, the account to be debited is cash. Automatically we go to the cash account and we debit the cash account, and in details we indicate capital. Why? Because it is its corresponding account, the capital is credited. Then the amount here, 100,000. We shall have to go back to the capital account and credit the capital account. In the details, we write bank because bank account is going to increase. It is a corresponding account, a corresponding book with 100,000. Then go to the bank account and debit bank account. This is to complete our double entry. This is the second entry. We credited capital. Now we are debiting bank to complete an entry as a rule. So in the details capital, then 100, 100,000, 100,000, 100,000. The first transaction is affected. First transaction is affected. But for the second transaction, we are going to need cash account. We are going to need cash account. That's why we are coming back to cash account. Why? The second transaction states that we bought a machine by cash. We paid cash. So we have to go to the machine. We are increasing the asset account, the machine account. We bought it 80,000 Rwandan francs. In the details, we have to put there cash. Then we go back to the cash account and we do what? We go back to the cash account and credit the cash account. Credit the cash account on 2nd June 2021. In details, we put a machine. Then we balance off this account. We shall total debit and credit. The debit has 100, the credit has 80, so the difference is 20, which is the balance carried down. Then we compute the totals here, 100, 100. Then we bring this balance carried forward to the next date of the month. It is 1st July 2021. Then the amount here is 20,000. We go next to the bank account. The bank account, we shall not need again bank account. We are going to close it off. We are going to balance it off. By balancing it off, as usual, we total debit and credit. Debit has 100, credit didn't have anything. So we need 100,000 Rwandan francs for the debit side to be equal to the credit side. Then we draw two parallel lines and bring to an opposite side. At the last step, the balance carried down changes the side to the bigger side and becomes the balance brought down, that is 100,000. Then we go to the machine account, we also balance it off. On 30th June 2021, the balance carried down is 80. Then we compute the totals and draw two parallel lines. And on opposite side, that is the debit side, we bring the balance carried down and we changes its name on first date of the next month, that is July 2021. The balance brought down or brought forward is 80,000 Rwandan francs. So we are done with posting to the ledgers. Now we are done with posting to the ledgers. Our bank account is balanced off. The machine account is balanced off. And everything is balanced off. So everything is balanced off. So we have to go to the trial balance. Before we prepare a trial balance, here is the meaning of the trial balance. The trial balance is basically a list of debit and credit balances extracted from the ledgers at a particular date. It is also a tool that is used to prove arithmetical accuracy of the entries made in the ledger. And if the records have been correctly maintained based on double entry system, the totals of the credit and debit would be equal. Here is the format of the trial balance. You have to put there the title. A title, for example, the name of the company as at the end of a given date. Then the particulars here or the account details, debit and credit. Here on the debit side, you bring the balances, the other normal balances. If it is an asset, of course, all the debit balances of the asset account will be written. They will be transferred here to the debit side, expenses debit side, revenues credit side, capital credit side, and any liability account on the credit side. Also, at the end, you have to compute the totals and draw here two parallel lines to show that the debit and the credit are equal. Using the previous information, John's trial balance, remember that we have the ledgers, the account details here, the account titles, account details, debit, we have credit. Remember that for us to be able to prepare the trial balance, we need to take information from the ledgers. The balances from ledgers have to be transferred here to the trial balance. For the cash, we have 20,000. Remember, we got 20,000. For the cash, we got 20,000. Now for the bank, we got 100,000. For the capital, we got 200, a credit balance of 200. For the machine, we have a debit balance of 80. Then the total comes to 200 on debit and 200 on credit.